Welcome to the CLS Market Review for the fourth quarter of 2014. I'm Nick Rowert, host of the CLS Market Review. Excited to join you here in our studio for the first time. The third quarter kept the winning streak alive, at least for the S&P 500. This was the seventh consecutive positive quarter for the S&P. The stock market has only had 3 longer streaks, with the last ending back in 1998. Not all markets gained last quarter, though, with domestic small caps and international equities both moving backward. In this quarter's broadcast, we will review our stock and bond market outlook and then discuss relative valuation. But first, we join CLS analyst Kostya Edis on the trading floor to review what has worked and what has not worked in the markets so far this year.
Thanks, Nick. Within stocks, large caps led, while small and micro caps actually lost ground. Sectors such as healthcare, technology, and utilities had particularly strong performance year to date, while consumer discretionary and industrials lagged. Within bonds, it was better to emphasize longer maturity bonds as short-term debt lagged. Among alternatives, real assets, REITs, MLPs, and preferreds were the stars, while commodities sustained losses, particularly in the last few quarters.
Thank you, Kostya. We begin our outlook with the bond market outlook. While interest rates are low and thus return expectations are uninspiring, it's difficult to get too bearish in the current environment for 2 reasons. First, the multi-decade-long bull market remains intact. And second, global yields are even lower than they are in the U.S. To dive deeper, we welcome portfolio manager Mark Pfeffer. Mark?
Thanks, Nick. Investors should recognize that anything is possible. Rates could fall. In fact, yields on 10-year government bonds are lower in many countries. We share concerns that the long-term prospects for bonds don't look great. Take a look at this chart of long-term 10-year Treasury yields going back to the 1980s. Yields dipped below 2% last year, but finished 2013 at 3%. The long-running bull market in bonds may be nearing its end, yet it's also hard to decisively say that the bear market has begun either, especially since yields have fallen this year and over the last quarter. Nevertheless, we believe the best predictor of future long-term bond market returns is the current yield of the bond market. Given that 10-year Treasuries are less than 3%, the prospects moving forward just don't look that bright. Of course, this assumes that bond returns are only about interest rate movements, and that is definitely not the case. Credit risk. The risk that bond interest and principal might not be paid is another key driver of bond returns. It's not probable that bonds will provide a return anything like they have in recent years. Over the last 20 years, for example, long-term Treasury bonds have had an annualized return of 8%. Over the next 20 years, it's going to be extremely difficult to match that.
Thank you, Mark. Now, let's take a look at the key factors affecting the market outlook for the remainder of the year. For the stock market, we'll examine earnings growth, current valuations, and sentiment. For this, we'll turn to our Chief Investment Officer, Rusty Vanneman. Rusty?
Thanks, Nick. Earnings growth continues to impress. Currently, consensus expectations are for the S&P 500 to have nearly $112 earnings per share by year's end. That would be about a 12% year-over-year growth rate, which is well above the long-term average of 6%. Meanwhile, emerging market earnings growth has been slowly improving the last several quarters, though still clearly behind the absolute level of U.S. earnings growth. This earnings growth difference helps explain the relative performance between emerging markets and the U.S. in recent years. Moving forward, however, given that strong market gains typically favor markets with earnings growth turning positive from negative levels, the future seems promising for emerging market equities, especially if the year-over-year earnings growth keeps moving higher. When it comes to valuations, as of the end of September, the earnings yield, which is the earnings per share divided by price per share, for the U.S. was just over 5%. The dividend yield, meanwhile, was 2%. Both of these valuations are below their 10-year averages, suggesting that the market is not on sale. For a back-of-the-envelope estimate of expected returns for the U.S. market, simply add the earnings yield to the dividend yield. This results in an expected return of just over 7% in the years ahead. Now, looking at emerging markets, at the end of September, the earnings yield was nearly 8%. The dividend yield was almost 3%. Both of these are above their 10-year averages, suggesting that emerging markets are priced for returns well above the United States. That's why we have been trimming domestic equities in favor of international equities, including the emerging markets. For the most part, investor sentiment has been too bullish this year, including at the end of September. Usually when investor sentiment gets this stretched, stock market returns moving forward tend to be below average. There are two reasons why investor sentiment extremes often presage market reversals. First, when everybody is bullish and already in the market, where will the fresh buying power come from to keep pushing the market higher? Second, when expectations are very bullish, then most, if not all, of the good news is already baked into prices. The market then becomes vulnerable to shifts in expectations when the news flow starts to reverse.
Thanks, Rusty. We turn now to relative valuations, a measurement CLS uses to help drive investing decisions. For this, we go to a special segment with our Manager of Investment Research and Portfolio Manager, Paula Week, who will introduce the CLS Chart Pack, a proprietary tool designed for valuation measurement. Paula?
Thanks, Nick. We are excited to be rolling out the CLS Chart Pack in the near future, and today we wanted to offer a first look. We'll begin with technology, whose relative valuation chart shows that the sector remains attractively priced. In short, while technology typically trades at a 50% premium to the overall market, the Russell 3000, it is now trading close to a 20% premium. Assuming that technology valuations move back to the long-term average, technology remains poised for continued outperformance. As with all charts we will review in this segment, the thick red line in the center is the long-term average relative valuation. The brighter gold lines represent one standard deviation away from the average. So in other words, relative valuations are within the standard deviation lines 67% of the time. All valuations consist of a composite of these 5 valuation metrics: price to earnings, price to book, price to sales, price to cash flow, and price to dividend. Ideally, all else being equal, a market that has a relative valuation that is at least one standard deviation below its long-term average is attractive. It's even more attractive if the relative valuation line is sloped higher. Currently, the technology sector's relative valuation shows both of these attributes. CLS emphasizes technology in its allocations. Next, let's look at the consumer cyclical, often referred to as consumer discretionary's relative valuation chart. In this case, the sector is expensive. In short, while the consumer cyclical sector typically trades at a 5% premium to the overall market, it was recently over a 20% premium. Assuming that consumer cyclical valuations move back toward their long-term average, this sector appears poised for continued underperformance. CLS does not emphasize consumer cyclical in its allocations. Next, the consumer defensives, often considered consumer staples, relative valuation chart shows that the sector remains attractively priced. In short, while this sector typically trades at a 10% premium to the overall market, it is now trading close to par. Given the defensive nature of the sector, it should outperform during a market correction. An acceleration of economic growth and/or rising rates, however, could hurt sector performance. As you might guess by now, CLS does emphasize consumer defensive in its allocations. Let's look at the mega cap valuation chart next. This shows that the sector remains attractively priced. Mega caps typically trade at a premium to the overall market, but are now trading closer to par. CLS emphasizes mega caps in its allocations. Small cap stocks relative valuation chart shows that they remain expensive. In short, while small caps typically trade near a 40% discount to the overall market, it is now trading close to a 30% discount. To correct the overvaluation, and assuming relative valuations move lower, small caps would be expected to underperform going forward. CLS does not emphasize small caps in its allocations. The U.S. stock market relative to the global market shows a relative valuation chart that is not attractively priced. In short, while the U.S. typically trades at a 15 to 20% premium to the global market, it is now trading close to a 25% premium. In 2007, before the U.S. went on its multi-year stretch of outperformance, the U.S. was trading on par to the global market. CLS emphasizes international markets over domestic in its allocations. Emerging market international stocks relative to the U.S. market look attractive. Emerging markets typically trade near a 25% discount to the U.S., but the discount is now closer to 35%. CLS emphasizes emerging markets over the U.S. markets in its allocations. Developed international stocks relative to the U.S. market look attractive. Developed international typically trades at a 25% discount to the U.S., but the discount is now closer to 35%. CLS emphasizes international developed markets over the U.S. market in its allocations.
Thanks, Paula. And with that, we conclude our outlook for the fourth quarter of the year. Our next broadcast will be in January of 2015. Thank you for watching, and thank you very much for your time and trust in CLS Investments.